Okay, welcome everybody. Thank you for joining us for Beginner Price Action Scalping Strategies, another Learn It Live webinar by Pepperstone and conducted by FX Evolution. It's a really good topic I think we've got tonight. So I hope everyone's had a good week so far with Australia Day if you're from Australia, and that extra day off, and of course has been enjoying some of the great trades in the market. So welcome to tonight's session. Just before we get started, I'd like to just quickly let everyone know the risk warning. The information provided in tonight's video or webinar has been produced by a third party and does not reflect the opinion of Pepperstone. The information has been provided without any alteration or verification. The information contained in this video is generic in nature and for educational purposes only. The information does not take into account your personal objectives, financial situation, or needs. And of course, if you do require assistance, you should seek professional financial help if necessary. So just quickly check out that everybody can hear me tonight. If you can, just quickly pop that in the chat room. Really appreciate that, just to make sure. Seems like it's all working perfect. So what are we going to be covering tonight? So we're going to be having a look at a few things. Now, firstly, what I might do is I might just quickly send a cheat sheet. It's a free cheat sheet, and this is a pattern cheat sheet. So one thing with scalping that I like to do, and I think we like to do here at FX Evolution, is we're really big fans of patterns and price action. And anybody that's been attending a lot of our webinars would know that price action and patterns is one of the biggest things that we use to kind of predict, I guess, a trend or predict a direction. And it's one of those leading indicators. So it actually helps us be ahead of the pack rather than many of the indicators that you'll see telling you what has already happened. So most indicators out there are based on something that has already happened. Price action is based on what is happening. So that's really, really good. So what timeframes do we want to be scalping in terms of, what strategies work best and what timeframes should we be looking at? Building a scalping system on a points-based approach, incredibly important. Whenever you're looking at scalping strategies, you really want to think about what time frame you're using, but also a consistent system. Too many people have different systems. I was definitely one of them when I first started, and I had quite a few different systems. And I kept jumping in between, using one. I'd go like maybe 5 trades successful, then have 7 trades bad, and then just decide it didn't work. And that's not the best way to approach it. You want to have a business strategy for scalping. It's very, very important. And of course, what market conditions we're looking for before using the scalping strategy, and then live Q&A. So if you have questions, please feel free to pop them in the chat room and I'll try to answer them as much as possible. I'll just pop it back in the link. It's just because I double posted it. So what is scalping? So scalping is, of course, a trading style specializing in taking profits on small price changes. Probably not a surprise to most of you here. It's time intensive. It is important to know that, and chart intensive. So one thing I always get asked is what's the best time to scalp in terms of the market? It does a little bit depend on the type of pair that you want to scalp. So if you're trading, let's say gold, actually gold works really, really well in session opens like Japan and China market opens in the morning. So for Australians, it would be in the morning, and that's actually a really great time to trade gold. And then of course, London's also good, and into the US. If you're trading the Australian dollar, it's also good to generally trade it during the Asian session. But if you're trading something like the pound or the euro and you're scalping those particular pairs, you're probably going to want to trade those in the London session. So it's just important to understand that these currency pairs will move in their natural kind of areas and their natural time zones the most. And that is important when it comes to scalping and understanding how bigger moves you want to have. Now, in terms of time intensity, I think that it's often undermentioned that scalping is quite difficult when it comes to you've got to put the time in. If you don't think that you can spend 3 to 4 nights a week spending the time in front of the charts for at least 2 to 3 hours, I really don't know if scalping is the best strategy for you. You might want to look at day trading strategies and swing trading strategies. But if you can spend a Tuesday, Wednesday, maybe Thursday in front of the charts, it's a really great strategy because it gets you a lot of time in front of the charts, lets you understand price action. It's really perfect for you if that's what you're looking for. And of course, you get more transactions. So in some ways, it's more fun like that, but you will have higher fluctuations in your account balance. If you're basing your trading strategies on daily charts, you're generally going to have a higher probability with less trades. But if you're basing it on a 5-15-minute chart, you're generally going to have way more trades, but also higher fluctuations and a tendency to potentially take poor trades as well, which is something that you need to break out of. So actually the trades you don't take are going to be your most successful trades in some ways because they're the ones that are going to improve your probability. And of course, you need a strict entry and exit strategy. Just for anyone with that cheat sheet, it'll get sent to your email, so you should get it. Okay, so step one, we have to decide if scalping is going to be a primary or supplementary style. Now we've used this slide a few times, but the primary style scalpers will need to spend potentially hours in front of the charts, as we've mentioned. Supplementary style, what you might be able to do is have another style of trading, so maybe swing trading or day trading or something like that, and then you supplement that type of trading. Maybe Tuesday, Wednesday, you decide I'm going to do some scalping. This is going to be my scalping time. I'm going to focus on these pairs. So I think it's important to differentiate that as well. Of course, in terms of market conditions, we want to make sure we know whether the market is range bound or trending on the larger timeframes. Many people like to scalp the range bound markets. We'll look at how to identify one of those tonight for beginners. But I actually think that trending markets and scalping those is actually one of the best things because you get often bigger runs, which means higher reward to your risk. And of course, choosing the time frame. So most people say scalping, of course, 1 minute charts. I actually like to stick to the 5, 15, and 30-minute charts if possible. You can still be in and out of a trade very quickly. You can potentially only be in trades for 10, 15 minutes, maybe 20 minutes, but that's a really higher probability place to be. You have to think about logically, if I'm on a 1 minute chart, how many people are really looking at the 1 minute chart trading it? Most of the big traders aren't. It's more the algorithms that will be trading those timeframes. So try to stick to the 5, 15, 30 if you are a beginner, and even up to 1 hour. I think it will give you a lot of opportunities and better trades. And of course, spend time learning the way the market moves, times of day, the currencies react to different news events, etc. And that's something that will come with time. So points-based system with price action, one thing you'll want to do is you'll want to think about things like higher peaks and higher troughs or lower peaks and lower troughs. If you're not familiar with this type of thing in terms of reading trend from something more than just moving averages, it's something that I would learn. But if you want to know the moving averages that I recommend or we recommend on charts, the 20, the 50, and the 200, very good moving averages. So you'll see those on the charts when we get in to MetaTrader 5 in a minute. But if you want to learn how price action works and you want to learn, like really understand the market, start to look at price and look at your trends based on higher peaks, higher troughs, etc. Once you learn that, you'll have a lot more success as well in your trading, rather than just relying on, of course, the easy thing, which is moving averages. And everyone uses moving averages, I know, but price action and understanding trend that way, definitely worth it. So let's take a look at the market and actually talk about today potentially a scalp that was an opportunity for people and why and how I would break down this scalp. And we approach it very differently to what a traditional scalper may do. And that's because I really like high probability scalping. So I think if you can get to high probability scalping, that is the best place to be because you don't want to be going through those psychological kind of, oh, I've got 10 wins in a row, and you tell your friends about it the next day. And then the next night, bad things happen. And then, of course, they say, oh, how are you going tonight? And then you say, I don't want to talk about it. So understanding high kind of probability trades, very, very important. Okay, so I think we'll get started on the gold trade here. I actually have it on a daily. Now, I always do this with scalping webinars, and I do it for a reason. I've just got this one line here, and I think it's very plain for most people to see. I'll just highlight this. We had some resistance over here in the daily, and that resistance was broken, and then the market's come back down and tested this area. And in particular, we have this candle here. And many people will know this as either a pin bar or a hammer candle. So nice rejection candle on the point of what we call roll reversal. And if you don't know what roll reversal is, got a couple of slides, but definitely you want to learn about roll reversal when it comes to the market. So we're on the daily and we are here for a good reason. Then what we do is we go down to a 4-hour and we can see here, again, we're drawing just purely based on roll reversal and support resistance. I think it's pretty plain for a lot of people to see that this was resistance, the resistance was broken, and a similar approach where the market has come down and it has tested the previous resistance, and that is acting as support. So I've got somebody here that says they can't hear. A few people are saying that. Is everyone else okay? Could be the web program. I'll have to continue, but yeah, we will definitely upload this to the YouTube tomorrow. So if you need to watch it, you can do it then. So anyway, we've got that roll reversal here on the gold at 4-hour. Now, of course, still not scalping, is it? We go down to the 1-hour. And what I like to do is I like to focus on areas like this, and then I might take it down to something like a half an hour, 15-minute chart. And we're starting to see potentially a pattern here at the point of that roll reversal. What we've got is we've got a left, a head, and a right shoulder, and a really nice neckline. And the importance of seeing something like this is we're putting together so many reasons. And it may not seem like a beginner approach, but actually this is quite easy once you understand just looking at pure roll reversal in the market and just highlighting zones and starting to recognize smaller time frame patterns. And again, if you do download that pattern sheet, and it'll go to your email in probably 1 to 5 minutes, that will allow you to just recognize a couple of basic patterns that everybody or the big guys do use in the market. So we've got our left shoulder here, we've got our head, and we've got our right shoulder. And you'll notice it's at this line that this all occurs. Now, the reason you want to recognize this is because when this breaks and you get that body close above, that creates a scalping opportunity for us where we can say, okay, number one, we're wanting to enter at this point, or even at this point. They're all good entries. Number two, we have the distance, very important in trading, the distance of the take profit that we'd like to take, which is the difference from the head to the neckline. That's the beauty of patterns. And we've got our risk reward already settled for us. We enter here and our stop loss is going to be behind the right shoulder. So we know that's going to be our risk. You could even put it behind just this candle here, just because, of course, it was such a bullish candle and it's very close to the right shoulder. So you've got your head to the neckline, you know that's the distance, and it's probably about a 2-to-1 trade. So if you risked $100 on this trade, you would make $200 for the risk. And that's a very high probability trade because we've bought into this the daily, we've bought into this the 4-hour traders, and then we've gone and we've scalped it on the smaller time frames. And yes, I know again it's 30, but this same pattern is on the 15-minute charts as well. So absolutely, we do have all of those things. Another awesome thing about scalping this way or recognizing scalps this way is we also have these moving averages crossing to the upside on the smaller time frame as the break occurs. So remember, after this candle closes, these are crossed. The 20 and the 50 have crossed. We're also above the 200 at this point. Very, very important when you understand what 200 means. So I like all of those things coming together, and that's what you'll often find with patterns. If you get a double bottom pattern on a smaller time frame, often when that double bottom breaks will also be a 20 and a 50 cross. And that adds extra momentum to it, because when you think about it, if we have a 20 and a 50 moving average, well, guess what? There are a lot of algorithms out there that trade based on moving average basics. So if you have a 20-50 cross and it's above the 200, do we think that we could potentially be triggering some kind of algorithm in our favor? Yeah, someone might be trading on that algorithm. It's automatically making moves. There's 4-hour traders and daily traders with us. And that's where I get really excited, because I think, okay, this is a super high probability scalp. It also generally is over faster. So you can see here that after the close happened, we had quite a few nice half an hour candles, and we're in and out within probably a few hours here, probably about 4 or 5 hours, maybe 6. Now that's a little bit longer, but the same application can happen on the 5 minutes. So we'll go have a look at the Aussie in a minute as well, after going back to the slides, and you'll see how you can continuously get into a trend when you recognize a larger time frame. And some people don't like this approach in terms of they think, oh, well, I'm just scalping the 5 minute. Why do I have to care about the daily? You have to care about the larger time frames to a degree to give you a bias in the market. And then what happens is once you have that bias, every time you see things that are going bullish in the direction that you want to be going because you've got that bias on the larger time frame, you can pick these trades up and you will have a higher probability that they will be successful. So I hope that makes sense to a few people out there. And if you take anything out of this webinar, please take that. Absolutely, you should be paying attention to the higher timeframes. It was a huge mistake that I made when I first started trading. I just went and I sat on the 15-minute, 5 minutes, and I loved it, and even the 1 minutes. I loved those timeframes. But I ignored completely what was happening on the bigger timeframes, and I didn't understand that when someone puts billions of dollars into the market, they're doing so on larger timeframes generally. So what we want to be doing is we want to be trading with them, and we want to be trading with the algorithms on the smaller timeframes that are starting to scale in those orders. So these kind of events here work really, really well. So a few of you guys understand that out there, and if you do, just put it in the chat room and let me know, because I think it's such an important concept. And I hope it does make sense. Okay, so if we're looking at the market and we're thinking, okay, well, is the market in a trend or not? Now, with that gold, I think it's pretty clear that we had that hammer coming off role reversal. It was very bullish. Of course, it was above those moving averages on the larger time frame. All looks very much to the upside. But sometimes you're going to get a market where it's channeling. And what I like to do is usually use the 4 hour for this. And I find kind of a market that's channeling, or even the 15 minutes. And once I see a channel, and generally how I define a channel is I say, okay, 1 touch to both sides, 2 touches to both sides. When it hits that midpoint there, I like to say it's in a channel. So 2 touches basically to both sides, hits the midpoint, that's in a channel, then we can start taking advantage of potential scalps from the resistance and from the support. So definitely something that I would pay attention to when it comes to trying to be a beginner and understanding the markets. If you find a channeling market by the pattern, then you're most likely going to want to change or take profits and stop losses a little bit within the channel. So what I mean by that is if it's in the channel here and you're selling off, where do you think you might have your take profit? The best place to have your take profit is going to be in the middle and at the bottom, and you're going to want 80% to the bottom. So what you don't want to just say get greedy and go for everything. You want to say, okay, I know this channel is 25 pips long. I might only take, let's say, 20 or 22 pips or something like that profit from the top to the bottom. And that just allows you to kind of be a little bit sneaky and get in there just before, because the market knows that this is where everyone's got their take profit zones. And often it'll stop a few pips before, go off, and there's nothing more frustrating. So definitely something that we want to be paying attention to when it comes to channeling markets. So when with scalping, if you see channels, definitely change your strategy up a little bit. So it's either trending or really channeling or range bound markets. Once a channel breaks out, so we see, let's say, a break of the buy, it creates an opportunity for us to also take a scalp potentially in the direction of this breakout. And we're going to see one of these. I'll just quickly skip through those slides in a second on the Aussie. Another one, double bottom, double top patterns, definitely want to pay attention to those. So let's jump back into the charts, go to the Australian dollar, and talk about, again, the top-down approach into a scalp. So here we have the Australian dollar versus US dollar. Pretty clear to me, pretty clear, of course, in history, that we've got another one of, this time, a larger head and shoulders. Got our left shoulder, got our head, and we've got our right shoulder. the break occurred, really nice kind of bearish candle here. Of course, we've got a close, gap over the weekend, all sorts of things, and it's well into the full distance. It isn't completed yet, but it's well into the full distance. Now, when we're predicting, let's say, a move like this, it's quite a large move over many days. That gives us a bias to then potentially scalp the smaller timeframes in the direction of our bias. And there's nothing better than that. It's such an awesome thing to do. So let's just break this down and go down to the smaller timeframes. I'm happy to go to 5 minutes. Let's go 5 minutes. So where traditional scalper is going to be. So here we've got the market, and you can see that line's there, so you can see what the line's doing. So what I actually really like to do is, it's pretty obvious when it's broken that we're going to see some shorting. But inside a trend, what often happens is one of a few things. This is a pretty aggressive trend, but you'll often have, let's say, something like this. Multiple touches to a point of support. So here's 1 touch, 2 touches, 3 touches, and then of course the breakthrough. Now this gapped through and then came back. So there's 2 ways of trading this as a scalper. One is when a new low is formed, you literally just sell it and put your stop loss behind the last swing. So we'll have one over here in a second, and this is why I'm always so excited about these things. So we've got our 1, 2, 3 touches. In this case, it gapped over the weekend, but it then came back and it just hit the bottom. And that's what we call roll reversal. So that's the roll where the support becomes the resistance. So this gives us a great opportunity to be in the direction of the daily trend and potentially grab a couple of pips. So we might only be looking for 10, 15, 20, something like that. So we could potentially be in here, be out here, there's 17 points. Obviously our stop loss wouldn't quite be hit if we had it behind the swing up here. And there's so many pips to be had because you're in the direction of the larger trend. So roll reversal, definitely one opportunity, probably the more conservative opportunity. You've seen the break, it comes back, it gives you that kind of confirmation that the market has found this point of support and acts as resistance, and the sellers are in control of the market. The other one is the more aggressive break. So let's just get rid of this drawings for a second. Put that 1, 2, 3 over here. You can see that line pretty clearly. The close, very important, must be a close below, in this case. It must be a close. No wick, close. The body is under, a new low has been formed and confirmed. Very, very important when it comes to scalping. Always wait for the close. If you're waiting to 10 seconds before that candle closes, doesn't matter if it's a minute or a 5 minute or a 15 minute, things can look very different at the end of that 10 seconds. And I'm sure we've all been there. It's not fun. Sometimes things reverse very, very quickly in the market, and that is not something that we want. So the close, very, very important. So we'd be looking for closes like maybe this candle here, where it's closed to a new low, and it's really said, okay, there's a new low at this point. So then what we could do is we could say, okay, we're going to sell it here. We're going to place our stop loss above that 50 moving average and above the swing. And then of course we will take that all the way down to potentially one of a couple of different scenarios. A few different scenarios you could do. You could say, okay, I'm going to use the moving averages as my guide. So one thing a lot of people like to do is they get in here, they put their stop loss above the 50, they recognize the pattern of what's been happening. The 50 is acting as dynamic resistance on the way down, even here. So what you can do then is you can say, okay, well, it's most likely going to continue acting as dynamic resistance all the way down until it eventually breaks. So what you do is you'll just continuously follow. You might put, let's say, a slightly higher moving average on, and you'll just follow that moving average all the way down until it gets hit. So let's say when effectively, let's say a 10 higher moving average gets hit, and it's going to be when the market tapers off down here because they're all basically hitting each other. So somewhere down here, we're going to get hit out. We got in up here, about there, and we've taken a serious amount of pips on a serious scalp. That's pretty exciting to me. that's obviously an aggressive trend, but the same kind of scenarios happen time and time again. And one of my particular favorites is waiting for multiple supports or multiple resistances. So that 1, 2, 3 shows the base. Then when that base breaks, generally that means a huge flow of money has come into the market and it's pushing it lower, and it's in the direction of our trend, of our bias. Now, the importance of the direction of the bias is something like this. So already the market was quite short with the Aussie. It was going down. Most of the moving averages were agreeing with a selling market. What happens if we have multiple kind of resistances and then it breaks, but it's in the wrong direction? It's not in the direction of our bias. Well, yes, it broke. Yes, it goes higher. But look how little amount of pips or little amount of price action happens compared to that one we saw when it's in the direction of that larger time frame. It's amazing, isn't it? That's how bad it is to sometimes counter trend on the scalps. You will never get, or generally you will never get, a large take profit and risk reward kind of ratio when you counter trend. And unfortunately, it's built into our human psychology to counter trend. So when it comes to the markets, I did it. I loved counter trending. I loved going against what the market was doing and trying to get better price and trying to pick the bottoms and trying to do these things. When actual reality is you probably want to be trading with the trend. Hard to do actually, because you're taking effectively worse price. And when you're taking worse price, it doesn't feel good. It never feels good, but something that does pay off in the end. So even if you don't have the confidence to do it now, you could even have two kind of trading accounts, maybe one with a smaller amount of money in it or demo or something like that, and you'll have your normal one. And if you just think, okay, I'm taking these other trades, I'm taking them in the direction of the trend, the prevailing trend, and I'm going to pay attention to this and give it a shot, you'd be surprised how successful that is. For anyone that's come in late, which is quite a few of you, yes, this will be recorded and it will be on the Pepperstone YouTube channel, so definitely check that out. Moving averages are the 20, 50, and 200. Anthony? I believe the volatility index might be coming soon as well, blessings, which is really, really good, because that will definitely help a lot of people as well. And I think we'll be running potentially a webinar on volatility index as well. So definitely stay tuned for that. Very, very interesting topic. So what we've covered is we've covered a little bit of role reversal. We've covered the idea of having a large time frame for our scalps and then scalping within it. And we've covered, of course, patterns on that role reversal on the smaller time frames in the trend. So those kind of things, even if you're a beginner and it sounds like you're putting a lot of things together, it's surprisingly easy. One of the easiest things I've found for beginners is literally if you want to get a bias and you don't want to read price action and do those kind of things, you can almost just say, if price is below the 200 moving average on the daily, I'm only going to look for shorts. So if price is above the 200 moving average on daily, I'm only going to look for longs. And surprisingly, it's pretty accurate over the long term. All right, we'll go back into the slides. Exponential. Yes, it will be sent to you as well, I believe, in terms of the webinar. So we always want to have kind of a bit of an idea of what trend's doing. This is just a quick example of what a channel or a range-bound market might look like. Again, it doesn't matter what time frame it is. It could be a 5 minute, could be a 1 minute, could be a daily. Just gives you an idea of once you've recognized multiple resistances and multiple supports, you can then figure out where you want to put your take profit. Here's an example of a great double top. Absolutely great double top. So if we've got our top here, got our top here, and beautiful rejection here as well. It's a nice shooting star at the top of the resistance. You see it all the time. But when you start to understand what that means about price action, this is effectively a fake out. Oftentimes what you'll see is this will happen at the beginning of market session opens. You'll see that fake out, everyone gets in, everyone goes, oh yes, I can see the breaks coming, completely reverses in the last 1 minute, and then of course comes back down. Here's the point where we've got our break of the double top, and of course then markets come down a bit, come back up, and then of course sold off in the direction. Now stop loss should be above the highs up here if we're trading that type of thing. And then as it makes a new low here, we can move the stop loss down. So that's just an example. It could be a 5 minute, as I said. It could be a 60 minute. It could be a 15 minute or a 1 minute. It really doesn't matter. That's a very good range bound market analysis. These are just a couple of really good patterns that are worth learning. Specifically, I think double bottoms and inverse head and shoulders and ascending triangles are incredibly helpful for scalpers. I think flags are really good for swing traders and people that trade in the larger timeframes. They can work on smaller timeframes, but definitely focus on double bottom, ascending, and inverse head and shoulders. Role reversal, we talked about it before, where we had that resistance becoming support and support becoming resistance. We've done webinars on it before. I know it's a beginner webinar, but it's just such an important thing that I think we always need to bring it up. This is the kind of thing that you're looking at in the market. It's what it does look like. We use this slide all the time. Probably should update it and get even a different one for a lot of people that come to all these webinars all the time. But effectively, we have that multiple resistance, that 1, 2, 3, of course, 4 touches. The break happens, and then that resistance becomes support. Again, this is a 4 hour, but it doesn't matter. It could be a 5 minute. It really doesn't matter. That's the type of thing you're looking for. Multiple touches means that was a significant zone, and it generally is respected on the pullback. This is kind of what we were talking about before on the Aussie in terms of multiple touches to a low, 1, 2, 3, breaks through, potentially comes back, does the role reversal, or you can take the break in the direction. Of course, if it's an aggressive trend and you've done your analysis on the larger timeframes, generally speaking, you're going to have more success of it being aggressive in that direction. Okay, so we want to optimize our entry for scalping as well. Big beginner mistake is they don't wait for closes. So when it comes to optimizing our entry, we want to enter based on confirmation. So confirmation closes, not on gut feeling. Make sure you do that. It's very, very important. We don't want to break even trades with fixed pip amounts. Use percentages. So what we mean by that one is if you expect to make 20 pips in a scalp, then you don't want to just say every time I'm up, like, you know, maybe for 10 pips, I'll break even the trade. You want to say every time I'm up maybe 70% of what I expect, I'm going to break even the trade or move my stop loss to 0. That's a much more effective way of being market adaptive. It's again a big mistake people do. They usually fix a pip stop loss and then say, okay, I'm going to use this stop loss every time, I'm going to use this contract size every time, and I'm going to use this break even points every time. So definitely try to get out of that idea. And of course, we say it many, many times, spend time learning the way the market moves, because it does move different over different times. Target higher multiples, so things like aim for trades over 1-to-1 with scalping. I've got a lot of people that I've coached over the years that have come with, I guess you could say, like 70% winning systems, but they're taking less than their stop loss. So what that means is they might say, okay, I risk $100, but I only take 60 on average. And by doing that, what happens is you need to be winning so many times, because for every loss, you've got to make that up. So definitely something very, very important when it comes to targeting multiples. If that's a bit of a real example and you do that, yeah, try to get to that 1-to-1 or better. By following the larger timeframes, you will have higher R multiples, especially if you're trading in trend. And of course, you want to practice that discipline. Okay, so creating a trade system based on multiple entry criteria. So tonight we've talked about a few things. We've talked about moving averages, one of the most basic things when it comes to scalping, when it comes to trading, and we've used that 20, 50, and 200. and an EMA, so exponential is what you should be using in those ones. Exponential a little bit faster for the 20 and the 50. Support resistance, very, very important when it comes to understanding, I guess, a lead indicator. So things like support resistance, worthwhile researching on, either doing something like our course, or of course, you can find some basic information online that will definitely help you. Candle confirmation, incredibly important. You want to see those closes. You want to see the candle close on the 5 or the 15 minute in the direction that you want it to, and then you will take your trade. And of course, Fibonacci retracement. Didn't cover that too much tonight, but Fibonacci retracements go hand in hand with something like role reversal. So if you're seeing role reversal and that role reversal is happening with a Fibonacci pullback, like a 38.2 or a 50 or even a 61.8, even better. The more reasons you have, the better the trading is. And of course, there are some indicators that we really like, things like MACD, stochastic, Bollinger, they're all great. You want something like minimum, maybe 75 points. And the reason we say that is if you have 3 reasons to be in the trade, that's better than having 1. But you also don't want to lie to yourself. And I never recommend, and you'll notice we did this with the MACD, stochastic, and Bollinger. We added all these indicators, and even if you had all 3 agreeing with you, still only 25 points. Because it's too easy to have multiple indicators that all actually tell you the same thing. A lot of people say, oh, I'm going to put RSI, I'm going to put stochastic, I'm going to have all these things. And 3 of them agree with me. Problem is 3 of them interpret the data very, very similarly. So that's why I really like flowing on from that price action. In terms of recommended pairs for beginners, absolutely. I think gold is great for commodities. I think things like the Aussie US dollar, I think the Euro US dollar, any of those major US dollar pairs are very, very good for scalpers. They're very technical, and on the smaller timeframes, they're very good. I would not recommend you go into generally heated political environments outside of some of the Western places, just because if you're trading, I think a great example probably was the Turkish lira. I always pick on that one. It can move very quickly if something happens, specifically, of course, if the US puts some kind of sanction on them. You will see a massive, massive move on those currencies. And that's good if you're in the right direction, but it can also blow your scalp out. You've got to think, if I'm trading this pair, what is my major risk of, could it gap past? Could it go further? What can happen? So I definitely think that it's often understated. You know, the US dollar Swiss and the Euro Swiss, just click on your chart, click on a monthly, and you're going to see a serious move. And I can tell you it was even worse than probably what you're seeing there, because at one point there was no liquidity and it just went straight through. So if you're trading a pair that's pegged or trading a pair like that and you're scalping it, your stop loss might be 20 pips, but it could be more. So do always think about that. Recommended times for scalping, pre-London. I really love pre-London. If you're an Australian or you're even in Europe and you have the ability to get up probably about half an hour before London opens, that is a perfect time for getting into scalping. I really think it's great. You get some great setups. You get to see a lot of fake outs, so it really teaches you some great methods, I think, and also teaches you what to look out for. And you get a lot of action. So definitely pre-London. I've got a few questions about that, by the way. So creating a business plan for your trading strategy. Of course, in our course, we have Presic, which takes into consideration price action, risk management, ELD, which is like multi-time frame analysis, but a little bit proprietary, chart patterns, indicators, and charting techniques. So we use actually one of each one of these reasons. So a little bit more than 3, but again, it's very important. I think it's Niall here, lives in South Africa. Yeah, you should be okay with timing for London. Just depends whether you work full time as well. So yeah, Pressic's really, really good for that, like kind of creating a business plan, but you should definitely create one. One tip I've always got for everybody, and sounds a bit old school, is potentially print the reasons why you like to get into trades, print them off, laminate it, and then literally just get a texter. And every single time you're about to place a trade, you've got that sitting next to you. It's that visualization, and you might just get it and tick the ones that you have and then score it up at the bottom. And it could be as basic as that. At least it will make you think of your decisions. It's too easy when you're sitting there and you're about to place a trade when it comes to scalping and just press the button. maybe even, and then button doesn't go well, and you maybe double the contract size and press the button again. So I would recommend if you are trading with MetaTrader 4 or 5, speak to your Pepperstone kind of representative and ask them if they've got the advanced trading tools and if you can get that installed, because they have some really good risk management software in there, and that actually might even change your trading. So definitely worthwhile checking out. Okay, well, we'll hand it over to questions and answers, I guess. If anybody has any major questions, I was doing a little bit solo tonight, so you have to excuse me. I couldn't answer everybody's questions there, but yeah, I'll answer a few now. I'll just read through these, some good ones here. If anyone's interested, we are actually doing a webinar straight after this one. It's more based on, I guess, the current pairs, so you're welcome to come along to that. I've put that in the chat room. And also, for anybody who's interested, we've made a kind of FX Evolution public Telegram as well. So you can just follow that link and gain access to that as well. London is, yeah, in terms of the timing, I actually like to get a world clock when it comes to scalping. So definitely worthwhile looking up a world clock and then having a look at just searching Google, literally like world clock session opens. And what you'll find is that when you do that, you'll be able to see all of the different times. You'll also be able, it should update as well to daylight savings time. And I know that there's a point where Australia and London, it's like a double daylight savings time, and that can get quite confusing. So do have a world clock, very, very important. EMA, Garfield, in terms of the moving averages we spoke about. Yeah, leading indicators. When I say leading indicators, price action is the best leading indicator. So definitely worthwhile considering price action. The problem with a lot of the things like stochastic is they're using price action to create the indicator. Yeah, I can go back and quickly. So E is ELD. So that's kind of like, I guess, secret sauce to a degree in our course. But yeah, multi-time frame analysis, very important. So think of it as a little bit like that. Definitely worthwhile watching out for. Adelicious. I've got a few other questions here. What should we do in a break scenario? I do see the trend, but no real direction. Should we buy or sell? Okay, so if you see a trend and you see in that direction of trend something similar to that Aussie, we'll quickly go back to the Aussie 5 minutes, and you see something like that multi-touch, so that 3 touches like I was talking about, 1, 2, 3, 1, 2, 3. 3 is a really good amount. Usually the 4th actually is a breaker. So if you do see that and it's in the direction of trend, you just wait for the close underneath and then of course put it behind the swing. But you want to have that bias on the higher time frames. RSI is a good indicator, absolutely, Oscar. You can use it in these time frames, no problems. All right, well, I think we'll probably wrap it up there. This will be uploaded, as I said, to YouTube. We will be covering some great topics in the future, so stay tuned for February because I think it's going to be a great month. Some new topics coming in as well. Great for scalping, great for any type of trading, really, those ones. And yeah, hopefully you guys really enjoyed this. All right, thank you very much, everybody. Seems like we've got some good feedback there, so really do appreciate that, and we'll see you in the next webinar.